Good day, everyone. You're welcome to this week's Business and Investment Tips Program, a production of RCCG Christ Church Radio with Dr. Ayodeji Ebo, an investment professional. This week, the focus is on February 2026 inflation report. Disinflation continues, but price pressures reemerge. The National Bureau of Statistics, NBS, has published the February 2026 Consumer Price Index report, indicating that Nigeria's inflation continues to slow down on an annual basis, although price pressures increased again month on month, suggesting that the disinflation trends remain fragile. Headline inflation for February 2026 stood at 15.06% year-on-year, marginally lower than 15.1% recorded in January 2026, confirming that inflation is gradually declining. However, on a month-on-month basis, prices increased by 2.01% compared with a decline of -2.88% in January, indicating that the general price level rose again after the sharp drop at the start of the year. This suggests that although inflation is decreasing compared to last year, the cost of living still rises and progress is not yet enough to fully increase the burden of households. Food inflation, which remains the largest factor driving headline inflation, rose to 12.1% year-on-year in February 2026, up from 8.9% in January 2026, showing that food prices peaked again after a sharp slowdown earlier in the year. However, on a month-on-month basis, food inflation jumped sharply to 4.7% from -6% in January, suggesting that food prices are beginning to increase once more after the seasonal dip earlier in the year. The increase was caused by higher prices of items such as beans, cassava, crayfish, yam flour, millet flour, vegetables, and cowpeas, showing that supply constraints and distribution costs continue to impact food prices. Core inflation, which excludes food and energy prices, fell to 15.9% year-on-year in February 2026, down from 17.7% recorded in January 2026, reflecting the ongoing impact of exchange rate stability, improved FX liquidity, and the effects of tight monetary policy. However, on a month-on-month basis, core inflation rose by 0.9% from -1.7% in January, indicating that underlying price pressures have begun to increase again, even though the overall trend remains downward. Urban inflation stayed higher than rural inflation, with urban inflation at 15.5% and rural inflation at 13.9%, indicating that cost pressures remain more intense in cities where transport, rent, energy, and services expenses are greater. Month-on-month inflation was also higher in urban areas, confirming that households in major cities continue to face rising prices despite overall decline in the headline rate. Inflation also varies significantly across states. In February 2026, the states with the highest year-on-year headline inflation were Kogi 23.6%, Benue 22.9%, and Anambra 22.1%. States with the lowest year-on-year headline inflation were Katsina 7.8%, Imo 11.7%, and Ebonyi 11.7%. On a month-on-month basis, the largest increase were observed in Enugu, Ogun, and Anambra, indicating that price pressures remain uneven across the country and mainly affected by local food supply, transport costs, and regional economic conditions. Overall, the February inflation rate confirms that Nigeria remains in the disinflationary phase, supported by exchange rate stability, improved agricultural supply, and tight monetary policy. However, the rebound in month-on-month inflation, particularly in food prices, indicates that the decline in inflation is not yet fully secure. Additionally, the current global tensions, which have driven crude oil and energy prices significantly higher, could introduce inflationary pressures in the coming months. Higher energy prices generally lead to increased transportation costs, higher production expense, and rising prices of goods and services, which may slow the pace of disinflation. Consequently, price volatility may persist in the near term, especially if fuel prices continue to rise, exchange rate stability weakens, or food supply conditions become tighter. Investment strategies to hedge against inflation. From an investment perspective, the current environment still demands discipline and proper asset allocation. Investors should avoid keeping funds idle in low-yield accounts, as inflation, although declining, remains higher than the return on most savings products. Treasury bills, FGN bonds, and other high-quality fixed-income instruments remain appealing, particularly as current yields are relatively high and may decrease once inflation stabilizes further. With the naira relatively stable compared to last year, but showing slight depreciation in recent weeks due to global tension and rising energy prices, investors should adopt a balanced currency approach. Those with excess dollar exposure might gradually reduce their position while maintaining some foreign currency diversification, and part of the funds could be reallocated into high-quality fixed-income instruments to secure current yields. In the equities market, the medium-term outlook remains positive, but higher global energy prices may raise costs of businesses and slow the pace of disinflation. Investors should therefore concentrate on fundamentally strong companies, particularly in consumer goods, cement, telecommunications, tier 1 banking, and energy while avoiding speculative positions and gradually accumulating quality stocks. Thank you for listening. Please join us same time next week for another interesting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed and have a great week. Bye.